Imagine clicking a single drop-down menu in your tax software, and you just select GEN for general category income instead of PAS for passive income.
Right, which seems like a tiny, almost invisible administrative typo.
Exactly, just a tiny typo. But because of that one click, you accidentally trigger a $100 million IRS audit for a Fortune 500 company.
Oh, it happens all the time.
I mean, the software doesn't throw a red flag, the client obviously doesn't notice, but somewhere in that massive interconnected architecture of the U.S. international tax return, that one misclassified data point begins to cascade.
Yeah, it corrupts the aggregate tested income pool.
It invalidates the foreign tax credit baskets, and, by the time the IRS supercomputers actually cross-reference the filings 3 years later, the penalties alone could just wipe out a quarter of the company's global operating profit.
Which is terrifying. And today, we are staring directly at the single piece of paper where that entire catastrophe begins.
Right. Form 5471, specifically Schedule I and Schedule I-1.
The stakes on these specific schedules, honestly, they've just never been higher.
If you are joining us for this deep dive, you already know that filing Form 5471 isn't just like an administrative census. It's not just a list of what a U.S. company owns overseas.
No, absolutely not. It is the active mathematical engine bridging a foreign corporation's economic activity on the other side of the planet with a U.S. shareholder's tax liability right here at home.
We are looking at the ultimate arbiters that dictate whether foreign profits are taxed immediately or, if they get shielded entirely.
And we have to talk about how the rules of gravity for that exact engine just completely changed.
Oh, the rules are totally different now. We are basing today's analysis on the December 2025 revision of these forms.
Which is a massive update.
It fully integrates all the chaos introduced by the One Big Beautiful Bill Act, the OBBBA that passed this past July.
Right, that's Public Law 119-21.
And if your compliance models are still relying on that classic 1-month deferral for controlled foreign corporations, you are currently driving a train straight off a cliff.
You really are. The elimination of the 1-month deferral rule in Public Law 119-21 is just a structural earthquake.
It really is. So can you break down what that old rule actually was?
Sure. So for years, tax planners utilized this perfectly legal mechanism. A specified foreign corporation could actually elect a tax year beginning 1 month earlier than its majority U.S. shareholder.
So if the U.S. parent was on a standard calendar year ending December 31st, the CFC would end November 30th.
Exactly.
Which effectively gave the U.S. parent an 11-month, completely interest-free loan from the government on all that foreign income.
Yep. Because the inclusion didn't actually hit the U.S. return until the following year.
That was a massive cash flow float, and entire Treasury departments relied on that float just to fund their Q4 domestic operations.
Oh, absolutely. But that float is completely dead for tax years beginning after November 30, 2025.
Just wiped out.
Yeah, the new legislation forces the CFC's tax year to align perfectly with the U.S. shareholder.
But the IRS knew this sudden alignment was going to create a pretty catastrophic bunching of income, right?
They did. You suddenly have taxpayers having to recognize, 13 or sometimes 23 months of foreign income in a single U.S. tax year.
Which is just brutal for cash flow.
It is. So to sort of mitigate the bleeding there, they released Notice 2025-75.
Right, the pro rata share transition rule. I was looking at the math on Notice 2025-75, and it looks like a complete dual-track accounting nightmare.
It really is a nightmare.
Yeah.
It alters the treatment of certain dividends paid or deemed paid during this whole transition period.
So that you aren't hit with double taxation on that pinched income.
Exactly. But here is the catch. The compliance burden of proving which dividend belongs to the old misaligned year versus the new aligned year, well, that falls entirely on the taxpayer.
And that proof has to be meticulously documented on the exact schedules we are dissecting today.
Yes. If you fail to trace those transition period dividends correctly through your accounts, the IRS will happily default to taxing that income twice.
So you're basically forced to run parallel ledgers for the next 3 to 4 years just to survive the OBBBA transition.
That is exactly what is happening.
Okay, so let's actually look at the architecture of this forced inclusion. To survive this transition, we really need to completely deconstruct Schedule 1.
Right, and the official title is Summary of Shareholders' Income from Foreign Corporation.
But functionally, I mean, Schedule I is essentially the delivery mechanism for the anti-deferral regime.
It absolutely is. It's the mechanism that bypasses the corporate veil entirely.
Because historically, the U.S. respected the foreign subsidiary as a totally separate legal entity, right?
Right. Meaning there was no U.S. tax until a dividend was formally declared. But Schedule I exists to say, hey, we don't care if you declared a dividend or not.
It just captures the Subpart F income under Section 951 anyway.
Yes, and it pulls in Section 956 amounts too. It acts as the final itemized bill for the U.S. shareholder.
Okay, let's unpack this with a sort of analogy. If the foreign corporation is a kitchen making this massive, complex buffet, Schedule I isn't the recipe book.
No, definitely not.
It's more like the waiter bringing the final bill directly to the U.S. shareholders' table. It itemizes exactly what you were on the hook to pay for, even if you haven't eaten a single bite of the food yet.
That is a perfect way to look at it. The bill arrives before the food.
And that bill obviously doesn't exist in a vacuum. I want to trace the plumbing here. Once Schedule A calculates that final U.S. dollar inclusion amount, where does it actually land on the primary return?
Well, it depends on who you are. For corporate shareholders, the data flows straight from Form 5471 Schedule I over to Form 1120 Schedule C.
Okay, so it just becomes part of the U.S. corporation's gross income.
Right, and it's subject to the standard 21% corporate rate. But for non-corporate shareholders, like individuals or certain trusts, it flows to Schedule I of Form 1040.
Which brings up a really critical strategic divergence. Because an individual paying ordinary income tax rates on a Subpart F inclusion is getting absolutely crushed compared to a C corporation.
Oh, completely crushed.
I mean, an individual might be looking at a top marginal rate of 37% plus the net investment income tax, while the C corp just sits comfortably at 21%.
And this is exactly where the Section 962 election becomes paramount for those individuals.
Explain how that works.
An individual U.S. shareholder can make an election under Section 962 to be taxed on their forced foreign inclusions as if they were a domestic C corporation.
Okay, but the IRS doesn't just hand out corporate tax rates out of the goodness of their hearts. What is the catch on the back end of a Section 962 election?
The catch is a second layer of tax.
Ouch.
Yeah. When you make a Section 962 election, you get the 21% corporate rate on the initial Subpart F or GILTI inclusion on Schedule I.
And I assume you also get access to the deemed paid foreign tax credits on Schedule E.
You do, which individuals normally cannot claim at all. But here is the problem. You are basically creating a phantom corporate tier in the eyes of the IRS.
A phantom tier, meaning what happens when the cash actually moves?
Well, when the foreign corporation eventually distributes that cash to you as a real dividend, it's not considered previously taxed income to the extent it exceeds the corporate tax you already paid.
So you get hit with a second layer of tax upon actual distribution.
Exactly. Typically the qualified dividend rate.
Wow. So you are trading immediate cash flow relief and access to foreign tax credits right now in exchange for a guaranteed second layer of taxation down the road.
It is a highly sophisticated modeling exercise for high net worth individuals holding any foreign equity.
And the foundational numbers for that entire complex model begin right on lines 1A through 1A of Schedule I.
Yes, they do. Let's get into the actual mechanics of the Subpart F engine.
Lines 1A through 1A represent the original anti-deferral sniper rifle.
Yeah, the sniper rifle is a good term for it. The U.S. code doesn't tax all foreign income immediately under Subpart F.
Right, it looks for highly mobile, passive income or income generated from, artificial supply chain manipulation.
Exactly.
So let's start with the hybrid mismatch rules on line 1B, because this is where tax engineering gets completely weaponized.
Oh, it really does. Line 1B targets tiered hybrid dividends governed by Section 245 Cap A, subsection E, paragraph 2.
Let's walk through the actual mechanics of a hybrid mismatch. How does a company actually orchestrate something like this in the real world?
Well, a hybrid mismatch basically exploits the fundamental differences in how two sovereign nations define a single financial instrument.
Okay, give me an example.
Let's say a U.S. parent has a holding company in Luxembourg, which in turn owns an operating company in Germany.
Got it.
The Luxembourg holding company issues a specific type of financial instrument to the German operating company.
And the tax lawyers draft this instrument so that it has characteristics of both debt and equity.
Exactly. German domestic tax law looks at the terms of the instrument, and they classify it as debt.
Therefore, when the German operating company makes payments up to Luxembourg, Germany views those as interest payments.
Right. So the German company gets to deduct that interest expense, completely lowering its taxable income in Germany.
So the income is essentially shielded in the high-tax jurisdiction.
It is. But Luxembourg tax law looks at the exact same legal instrument and classifies it as equity.
Oh, wow. So Luxembourg views the incoming payment not as taxable interest, but as a tax-exempt dividend under their participation exemption regime.
You've got it. Double non-taxation.
That is wild. It's deductible in Germany and tax-exempt in Luxembourg. The profit essentially just vanishes from the European tax base entirely.
It vanishes over there, yes.
Yeah.
But how does the U.S. catch that on Form 5471?
Right. That is where Section 245, Cap A, subsection E, paragraph 2 comes in.
Exactly. If that hybrid payment happens between two controlled foreign corporations, meaning it's a tiered hybrid dividend, the U.S. code forcefully recharacterizes that transaction.
The IRS basically steps in and says, hey, we see the mismatch. You achieved double non-taxation in Europe, so the U.S. parent must recognize that payment as Subpart F income immediately.
Yes. And line 1B on Schedule I is exactly where that penalty inclusion is finalized.
It's a fascinating jurisdictional override. The U.S. is essentially acting as the global tax enforcer, penalizing the U.S. shareholder for exploiting European mismatches.
That's a great way to phrase it. And as we move down the schedule, lines 1C and 1D deal with tiered extraordinary disposition amounts and extraordinary reduction amounts.
And those lines are basically just the scar tissue of the 2017 transition from the old deferral system to the current territorial system, right?
Yeah, that's exactly what they are. When the U.S. announced it was moving to a territorial-style system with the 100% dividends received deduction, multinational corporations went into overdrive.
They immediately realized they had this very brief window to just shuffle assets between foreign subsidiaries to artificially create tax-free dividends.
Right, out of earnings that historically really should have been taxed. So lines 1C and 1D are the anti-abuse backstops to prevent that last-minute asset shuffling.
Got it. But I really want to spend significant time on lines 1N through 1O, because this is the true bedrock of Subpart F.
Absolutely.
Line 1A captures foreign personal holding company income, which is defined under Section 954, subsection C. We're talking about dividends, interest, royalties, rents.
Right. The core logic being, if your subsidiary in the Cayman Islands is just sitting there earning interest on $1 billion bank account, there is zero economic substance requiring that capital to be offshore.
It's purely passive.
Exactly. That's the baseline. But the true deep complexity of Subpart F is found on line 1F, foreign-based company sales income.
Under Section 954, subsection D.
Yes. This target is all about the artificial separation of manufacturing and sales.
Okay, let's run a real scenario on this to make it clear. Let's say I have a U.S. parent company. We manufacture high-end medical devices in a massive facility we own in Ireland. And then we sell those devices directly to hospitals in France. Is that foreign-based company sales income?
No, it's not. In your scenario, the Irish subsidiary is the actual manufacturer.
Because they have the factory.
Right. They are taking raw materials, transforming them, and selling them. The income is generated by genuine economic activity in Ireland. Subpart F completely respects that.
Okay, now let's manipulate the supply chain. I still want to manufacture in Ireland and I still want to sell to France, but I want the profit to land in a zero-tax jurisdiction like Bermuda.
I see where this is going.
So the U.S. parent sets up a Bermuda shell company. The Bermuda company buys the finished medical devices from the related Irish manufacturer exactly at cost.
Which means Ireland makes zero profit and pays zero Irish tax.
Exactly. Then the Bermuda company turns around and sells the devices to the French hospitals at a massive markup.
Even though the physical product ships directly from Dublin to Paris.
Right. The physical box never touches Bermuda, but the paper invoice routes through Bermuda, trapping 100% of the profit in a zero-tax environment.
That is the exact specific scenario Section 954, subsection D, was written to destroy.
So how does the code actually define that trap?
Foreign-based company sales income occurs when a CFC buys property from a related person and sells it to anyone, and the property is both manufactured outside the CFC's home country, so outside Bermuda, and sold for use outside the CFC's home country.
Meaning the U.S. parent is totally caught. They are forced to recognize all of that Bermuda profit immediately on line 1 of Schedule 1.
Exactly. But the multinational companies obviously know this rule.
Oh, of course they do. So they try to outsmart the definition of manufacturing itself.
Yes, they do.
What if the Bermuda company doesn't just buy the finished product? What if the Bermuda company owns the intellectual property, buys the raw materials globally, and then hires the Irish facility purely as a contract manufacturer just to assemble it.
Oh, the contract manufacturing defense.
Right. Bermuda claims they are the true manufacturer because they control the process and bear the economic risk, even though they have 0 employees on an actual factory floor.
You've just stepped into the branch rule and the substantial contribution test.
Which is where tax controversy just absolutely explodes.
It really does. Under the regulations, a CFC can be considered a manufacturer if it makes a substantial contribution to the manufacturing process.
Things like oversight, quality control, logistics management.
Yes, even if it doesn't do the physical assembly. If Bermuda can somehow prove substantial contribution, they totally escape foreign-based company sales income.
Which honestly requires highly aggressive transfer pricing documentation and usually a horde of expensive economists to defend during an audit.
It really is a razor-thin line between a totally legal supply chain optimization and a massive Subpart F inclusion on Schedule 1.
It's wild. And we have to recognize that the final numbers landing on Schedule 1, lines 1A through 1, are net numbers.
Right, they don't just magically appear.
They are the result of this severe mathematical distillation that happens on Worksheet A. You don't just dump raw gross income onto the schedule.
No, Worksheet A forces you to allocate definitely related deductions, apportion interest expense, and most importantly, test for exceptions like the de minimis rule.
Oh, let's do the math on the de minimis rule, because it creates an incredibly perverse incentive for corporate behavior.
It really does.
The rule states that if a CFC's gross foreign-based company income and gross insurance income is less than the lesser of 5% of its total gross income, or $1 million, the IRS basically just ignores it.
Yeah, the Subpart F inclusion drops all the way to 0. It's an administrative safe harbor.
Because if the footprint is small enough, the IRS just doesn't want to audit the minutia.
Exactly.
But look at the cliff effect of that specific math. Let's say a CFC has $19 million in legitimate, active, gross manufacturing income.
Okay.
And it also has $999,000 in passive interest income. Total gross income is $19,999,000.
Right. And the passive income is just under 5% and just under $1 million.
So the Subpart F inclusion is 0.
Correct. They are perfectly safe in the harbor.
Now, what happens if that CFC earns just $2,000 more in passive interest? Their passive income hits $1,001,000.
They immediately cross the threshold. The de minimis rule vanishes completely.
And suddenly, that entire $1,001,000 becomes subject to Subpart F allocation minus deductions.
Yes. For $2,000 of extra income, they trigger hundreds of thousands of dollars in taxable inclusion.
That cliff forces tax departments to aggressively manipulate their active gross income just to keep the denominator high enough.
Oh, I've seen it.
I mean, I've seen companies deliberately accelerate low-margin active sales at the very end of December solely to inflate their total gross income.
Just intentionally losing money on the operational side to protect the de minimis safe harbor on the tax side.
It is the ultimate tail wagging the dog,
Yeah.
tax mechanics dictating actual operational reality.
It is. But let's assume the company couldn't shield the income. The Subpart F is triggered, the forced inclusion is calculated on Worksheet A, and it finally lands on Schedule 1.
Okay, so the U.S. parent pays the tax. We have completely satisfied the anti-deferral regime.
We have.
Yeah.
But the cash itself is still sitting in the foreign bank account.
Right. And eventually, the U.S. parent is going to want to physically repatriate that cash. Which brings us to the next operational phase of Form 5471.
Dealing with dividends and the incredible traps of Section 956.
Let's talk about the filtration system for dividends first, specifically Line 5A and Section 245 Cap A.
Section 245 Cap A was introduced in the 2017 Tax Cuts and Jobs Act, and it's just fundamentally altered the repatriation landscape.
So?
If a USC corporation receives a dividend from the foreign source portion of a specified 10% owned foreign corporation, it is generally entitled to a 100% dividends received deduction.
Which on the surface sounds like a total free pass. It sounds like you just bring the money home and pay 0 tax.
It sounds like it, but it is definitely not a free pass. It is a highly aggressive filtration system.
Precisely. To get the 100% deduction on Line 5A, the dividend has to survive a brutal gauntlet of disqualifiers.
Exactly. First, are you an individual? If yes, the deduction is gone.
Second, have you met the 365-day holding period requirement for the stock? If no, the deduction is gone.
Third, is this a hybrid dividend like we discussed earlier? If yes, the deduction is gone.
And most importantly, does this dividend consist of untaxed earnings? Or is it distributing earnings that were already caught by the Subpart F or GILTI regimes?
Right. And this is where practitioners get confused.
Yeah, because if Section 245 Cap A gives a 100% deduction on foreign earnings anyway, why do we even care about the Subpart F inclusion up front?
It seems redundant, doesn't it?
Isn't it just a moot point? Whether I pay zero tax on the dividend or I pay tax on Subpart F but bring the dividend home tax-free later, doesn't it basically wash out?
It absolutely does not wash out. And this is probably the most dangerous misconception in international tax right now.
Break it down for us. Why doesn't it wash out?
It all comes down to foreign tax credit baskets. If income escapes Subpart F and GILTI entirely and just sits in the foreign corporation as untaxed earnings, and then you bring it home later under the Section 245 Cap A deduction.
You pay zero U.S. tax on that dividend.
Right. But you also are strictly forbidden from claiming any foreign tax credits associated with those earnings.
Because the U.S. isn't taxing the income, they certainly aren't going to let you use the foreign taxes you paid on that income to offset other U.S. tax liabilities.
Exactly. Your foreign tax credits are permanently lost. Just gone.
Wow.
However, if the income is caught up front by Subpart F, you pay the 21% U.S. rate, but you get to claim the Section 960 deemed paid foreign tax credits.
So depending on your overall foreign tax credit position, you might actually desperately want the income to be Subpart F.
Yes, you might want it to be Subpart F just to access those credits and soak up excess limitation in your passive basket.
That is literal financial alchemy. Companies aren't just trying to avoid Subpart F. Sometimes they are actively trying to trigger it to optimize their global credit position.
That's all about the modeling.
But let's look at a scenario where a company doesn't want to declare a formal dividend at all. Let's say they have $50 million sitting in a CFC.
Okay.
The U.S. parent needs that $50 million right now to fund, say, an acquisition in Texas.
Right.
But if they declare a dividend, maybe it doesn't qualify for the Section 245 Cap A deduction. Maybe they fail the holding period.
Or maybe they just don't want to deal with the local foreign withholding taxes on a formal dividend.
Exactly. So they decide to get creative. They don't declare a dividend. Instead, the U.S. parent goes to a U.S. bank, like Chase, for a $50 million loan.
Okay.
And they pledge the stock of the CFC, or the assets of the CFC, as direct collateral for that bank loan.
You have just walked directly into the blast radius of Section 956.
Line 2 on Schedule 1, earnings invested in U.S. property.
Yes, the pledge and guarantee trap.
Walk me through the mechanics of why the IRS actually cares about a bank loan collateralized by foreign stock.
Section 956 is designed specifically to prevent a U.S. shareholder from getting the economic benefit of untaxed foreign earnings without formally repatriating them.
So it's basically an anti-abuse rule for stealth repatriation.
Exactly. And U.S. property is very broadly defined. It includes tangible property in the U.S., and it includes an obligation of a U.S. person, like the CFC, making a direct loan to the U.S. parent.
But under the regulations, if a CFC is a pledger or guarantor of a U.S. person's debt, the CFC is treated as holding an obligation of that U.S. person.
Let me stop you there. So the CFC didn't actually loan any money to the U.S. parent.
Right.
The U.S. parent borrowed from Chase Bank. The CFC just signed a piece of paper saying, hey, if the parent defaults, Chase can take our foreign assets.
Yes. And under Section 956, the IRS treats that exact scenario as if the CFC took its untaxed foreign earnings, brought them to the U.S., and handed them directly to the U.S. parent.
It triggers a massive deemed dividend equal to the lesser of the untaxed earnings and profits of the CFC, or the principal amount of the obligation.
So the U.S. parent gets hit with a $50 million deemed dividend inclusion on Schedule 1, Line 2.
And they owe tax on it immediately, even though not a single dollar of actual cash left the foreign jurisdiction.
It is totally brutal. And what makes it worse is the interaction with previously taxed earnings and profits, PTAP.
PTAP is a whole other world of pain.
We really need to explore Schedules J and P because they are the only defense mechanism against double taxation when Section 956 is triggered.
Let's trace the radioactive tag on these earnings.
Okay, if I have a Subpart F inclusion on Line 1 of Schedule A this year, I pay tax on it. That specific block of foreign earnings is now classified as PTAP.
Right. It basically gets a radioactive tag from the IRS.
Yes, and that tag must be tracked in the functional currency of the foreign corporation across Schedule J.
Which tracks accumulated earnings and profits.
and Schedule P, which specifically isolates the previously taxed portions. The compliance burden of this is just staggering.
It's unbelievable because let's say 10 years from now, that CFC finally makes a direct loan to the U.S. parent, triggering a Section 956 event.
The tax department has to look back through an entire decade of Schedule J and Schedule P filings.
Convert historical functional currency balances and literally prove to the IRS that the deemed dividend is being sourced out of the radioactive PTEP pool.
If they can prove the earnings were previously taxed under Subpart F or GILTI, then Section 959 applies.
The earnings are excluded from gross income. There is no new deemed dividend under Section 956.
But the burden of proof is absolute.
It really is. If there is a break in the chain of your Schedule J history, or if the functional currency translation rules were misapplied during some corporate reorganization 5 years ago,
The IRS will just assume those earnings are untaxed.
and they will tax the exact same economic profit a second time. It's not just a tax return anymore. It's a forensic accounting ledger spanning the entire life cycle of the corporation.
Which perfectly transitions us to the modern era of Form 5471. Subpart F and Section 956 are targeted strikes.
They are. They require specific bad acts, hybrid mismatches, fake sales companies, pledging assets.
But in 2017, Congress realized that multinational tech and pharmaceutical companies weren't really doing any of those things.
No, they didn't need to. They were just legitimately transferring their highly valuable intellectual property patents, algorithms, to subsidiaries in low-tax jurisdictions.
And just letting the massive, completely legitimate royalty and sales income pile up there.
The sniper rifle of Subpart F was useless because the income was technically active and the IP transfer was legally sound.
So Congress built a dragnet, the Global Intangible Low-Taxed Income Regime.
Section 951 Cap A GILTI.
And the engine room for the GILTI dragnet is Schedule I-1, Information for Global Intangible Low-Taxed Income.
The most common mistake I see practitioners make is treating Schedule I-1 like an extension of Schedule 1.
They are mathematically and conceptually entirely different.
They really are. Schedule I calculates a final U.S. dollar inclusion for a specific CFC. Schedule I-1 does not calculate a tax.
Schedule I-1 is basically the raw functional currency ingredient list for a global aggregate calculation.
To understand why Schedule I-1 asks for what it asks for, we really have to understand the fundamental theory of GILTI.
Let's lay out that theory.
The U.S. government established a baseline assumption. Any profit a foreign subsidiary makes that exceeds a 10% return on its hard, tangible, depreciable assets must logically be derived from intangible assets.
Things like patents, brand value, proprietary software.
Exactly. And the IRS wants to tax that excess intangible profit globally. But unlike Subpart F, which is calculated CFC by CFC, GILTI is aggregated at the U.S. shareholder level.
So if a U.S. multinational owns 50 CFCs around the world, a manufacturing plant in Mexico, a software distributor in Ireland, a logistics hub in Singapore, they cannot calculate GILTI in isolation.
No. They have to extract the raw data from all 50 CFCs, pour it into a massive mixing bowl, and calculate the net global position.
And that data extraction happens directly on Schedule I-1. Let's look at the actual lines. Lines 1 through 3 calculate gross tested income.
You start with the gross income of the CFC, and then you begin subtracting statutory exclusions. The most important exclusion being income already caught by Subpart F.
Because the order of operations matters, right? Subpart F always eats first.
Always. If the sniper rifle hits it, we extract it before the GILTI dragnet sweeps the rest.
Correct. After exclusions, lines 4 through 6 require you to allocate and apportion deductions, local salaries, rent depreciation, to arrive at net tested income or a tested loss for that specific CFC.
And the fact that Schedule I-1 can generate a tested loss is a massive departure from Subpart F.
Because if a CFC has negative Subpart F income, it just zeroes out. It doesn't help you at all.
Right. But a tested loss on Schedule I-1 is incredibly valuable.
Because of the aggregate mixing bowl.
Exactly. When the data leaves Schedule I-1 and flows up to Form 8992, the U.S. shareholder calculation of GILTI, the tested losses of your unprofitable CFCs directly offset the tested income of your highly profitable CFCs.
It reduces the aggregate net CFC tested income. It's global consolidation for tax purposes.
But the most controversial and honestly structurally manipulative line on Schedule I-1 is line 8.
QBAI, Qualified Business Asset Investment.
QBAI is the tangible asset base. It is the average of the adjusted basis of specified tangible property used in a trade or business and of a type with respect to which a depreciation deduction is allowable.
Factories, heavy machinery, servers.
Right. Under the GILTI formula, your aggregate QBAI is multiplied by 10% to create your routine return shield. That shield reduces your GILTI inclusion dollar for dollar.
Which creates a fascinating and, frankly, completely perverse incentive structure for U.S. multinationals.
It really does. Let's run a scenario on this QBI incentive to show how wild it is.
Imagine a U.S. tech company. Their primary asset is software. They have a massive subsidiary in Ireland generating $500 million in net tested income.
Okay, that's a lot of tested income.
But because they are a software company, they have almost no tangible assets, just some laptops and rented office space. Their QBAI is virtually zero.
Which means they have almost no 10% routine return shield.
Yeah.
That entire $500 million is totally exposed to the GILTI tax.
So what does the tax engineering department do? They realize they need to artificially inflate their QBAI.
Right.
They advise the C-suite to have the Irish subsidiary buy a massive fleet of commercial airplanes or maybe build an enormous, unnecessary physical manufacturing plant for hardware they don't even need to sell.
Just spending capital.
Yeah, they spend $1 billion on heavy tangible assets.
They calculate the depreciation, and suddenly their QBAI on Schedule I-1, Line 8, skyrockets by $1 billion.
And 10% of that billion is $100 million.
They just generated a $100 million QBAI shield, wiping out $100 million of their GILTI exposure year over year.
Simply by buying physical assets they don't fundamentally need for their core software business. The tax code is actively encouraging U.S. companies to park capital in heavy foreign assets just to avoid a U.S. intangible tax.
It is the absolute definition of a perverse incentive. But the IRS is highly aware of this. And that is exactly why the data quality and categorization on Schedule Y1 is scrutinized at an atomic level.
You cannot just throw numbers onto the schedule. We really need to talk about the high tax exclusion because this is where the categorization becomes a life or death compliance issue.
The GILTI high tax exclusion, found in Treasury Regulation 1.95 1 Cap A2, subsection C, paragraph 7.
The theory of GILTI was to catch low-taxed intangible income, right?
Exactly. If your CFC is operating in Germany paying a 30% local corporate tax rate, you aren't hiding money in a tax haven. You are heavily taxed.
So the regulations allow taxpayers to make an annual election to exclude income from GILTI if the effective foreign tax rate on that specific income exceeds 90% of the U.S. corporate rate.
Currently, that threshold is 18.9%.
That sounds like an incredible relief valve.
Yeah.
Just exclude the highly taxed income from Schedule 1.1 entirely. Less tested income means less GILTI tax.
It sounds great on paper, but the compliance reality of proving that 18.9% effective rate is a nightmare because you don't calculate it at the CFC level.
Wait, you don't? How do you calculate?
You calculate it at the tested unit level.
Explain tested units, because I know this breaks people's brains.
A single controlled foreign corporation might operate a manufacturing branch in Germany, a disregarded entity sales hub in France, and a pass-through joint venture in Italy.
Okay, 3 different operations.
Under the high tax exclusion regulations, you cannot just blend all the taxes and all the income of the CFC together. You have to isolate each individual tested unit.
The German branch, the French entity, the Italian venture. You literally have to build a mini P&L for every single branch.
Exactly. You track this on Schedule Q. You allocate gross income to the tested unit. You allocate specific, definitely related deductions. You apportion interest expense.
And then, and I know this is the hardest part, you have to trace the actual foreign taxes paid specifically to the income of that exact tested unit to calculate the effective rate.
Right. So if the French tested unit hits 19%, it qualifies for the exclusion. But if the Italian unit hits 17%, it fails.
So on Schedule I-1, you are manually extracting the gross income and deductions of the French unit out of the tested income calculation while intentionally leaving the Italian unit in.
And this all has to be done in the functional currency of the CFC, which brings us to the ultimate point of failure.
Section 989, subsection B, the functional currency translation rules.
Let's go back to the drop-down menu error you mentioned at the very beginning of the deep dive. The chaos isn't just about putting income in the wrong category.
The chaos is that every single category translates to U.S. dollars using a totally different mathematical exchange rate under the code.
Let's do the math out loud so people can hear how crazy this is. Lines 1 through 10C on Schedule I-1 are reported in the CFC's functional currency.
Let's assume the CFC operates in euros, but the final U.S. tax return is obviously paid in U.S. dollars.
Right. Under Section 989, subsection B, net tested income is generally translated using the average exchange rate for the taxable year.
Okay, so you sum up the whole year and find the average euro to dollar rate. Let's say it's 1.7.
But QBAI, the tangible assets, is translated using the historic exchange rate from the exact date the asset was originally placed in service.
Wait, if the CFC bought a factory 5 years ago when the euro was at 1.30, you must use 1.30 to translate the QBAI shield today.
Yes, even though the income is being translated at 1.10.
Exactly. You have a severe currency mismatch inside the GILTI formula itself. Your income is floating on the current average rate, while your QBAI shield is firmly locked in time at a historic rate.
Let me stop you there and play this out. If the euro suddenly drops 15% against the dollar in Q3, the average exchange rate for the year plummets.
The U.S. dollar value of the net tested income drops.
But the QBAI shield remains artificially high because it's locked at the old 1.30 rate.
Which means currency fluctuations alone can magically wipe out a company's entire GILTI liability, even if the foreign factory didn't alter its operations by a single cent.
Conversely, if the euro strengthens massively, the U.S. dollar value of the income skyrockets, but the QDAI shield stays frozen.
The taxpayer is suddenly hit with millions of dollars in phantom GILTI inclusion driven entirely by Forex markets.
And when we tie this back to the categorization error, if that accountant hits GEN instead of PAS for $500,000 of interest income.
Not only does it illegally escape the subpart F average exchange rate translation, it drops into the GILTI aggregate mixing bowl on Form 89992.
It alters the net CFC tested income, and the cascade truly begins. Form 89992 feeds directly into the foreign tax credit calculation on Form 1118.
The U.S. Code requires you to silo your foreign tax credits into distinct baskets. A passive basket and a GILTI basket.
You cannot use excess taxes paid in the high-tax GILTI basket to shield passive income.
Cross-crediting is strictly illegal.
So by mischaracterizing that $500,000 as general tested income instead of passive subpart F, the taxpayer is artificially inflating their GILTI basket limitation.
They might actually use that inflated limitation to absorb foreign taxes they otherwise couldn't use.
The IRS supercomputers are programmed to find exactly this. They cross-reference the subpart F inclusions on Schedule I with the tested income on Schedule I-1.
And they map it directly to the basket classifications on Form 1118 and Schedule E.
When the math inevitably breaks, the Form 8992 is botched. The Form 1118 is botched. The ultimate corporate return on Form 1120 is fundamentally corrupted.
And the penalties for substantial understatement of tax under Section 662 are severe.
Not to mention the sheer cost of hiring forensic accountants to unwind 3 years of intermingled PTEP accounts, recalculate the historic QBAI translation rates, and literally amend dozens of Form 5471 schedules.
It's an unmitigated disaster born from a single keystroke, which, really crystallizes the core thesis of this deep dive.
Form 5471 and the intricate dance between Schedule I and Schedule I-1 is absolutely not a census.
It is a highly aggressive, completely unforgiving mathematical ecosystem. Schedule I is the enforcer.
It takes the sniper rifle of subpart F and the anti-abuse trap of Section 956 to forcefully rip mobile income and phantom dividends right into the U.S. tax net immediately.
While Schedule I-1 is the global data harvester, it forces U.S. multinationals to extract localized, functional currency data across hundreds of foreign entities.
They have to navigate the treacherous high tax exclusion at the tested unit level and dump it all into an aggregate U.S. calculation that is constantly warping under the pressure of historic versus average exchange rates.
And as a practitioner or, as a tax director, you have to realize that the era of close enough compliance is completely dead.
We are operating in a post-tax reform, post-OBBBA world.
The IRS possesses the computational power to trace a single dollar of hybrid mismatch from a German subsidiary through a Luxembourg holding company directly onto line 1B of your Schedule 1.
If you don't understand the mechanical flow of this data, you aren't just risking compliance penalties. You are actively destroying your company's global effective tax rate by losing foreign tax credits or missing out on the 100% deduction under Section 245 Cap A.
And I want to leave you with a structural reality to consider as you review your own international tax posture. Look at the life cycle we just traced.
A U.S. multinational earns $1 in Ireland. They calculate the functional currency net tested income on Schedule Y1. They aggregate it on Form 8992 to pay the GILTI tax.
That dollar is then reclassified as previously taxed earnings and profits. It is assigned a historical exchange rate and totally buried in Schedule J.
5 years later, the company pledges the Irish stock for a bank loan, triggering Section 956, and they have to prove that dollar is PTEP to avoid a deemed dividend.
10 years later, they finally distribute the cash, and they have to literally trace that exact dollar on Schedule R to clear the Section 245 Cap A filtration system.
The U.S. tax system has essentially forced multinational corporations into a permanent, lifelong marriage with their own historical data.
You are no longer just filing an annual tax return. You are curating a generational ledger of global profits, tracking radioactive dollars across decades and wildly fluctuating currency markets.
The question every tax department really needs to ask themselves is, does our data architecture actually support a generational ledger? Because the IRS's architecture certainly does.
A generational ledger of global profits. The territory is entirely invisible, written in statutory overrides and tested unit allocations, but the toll booths are relentlessly real. Thank you for joining us on this deep dive. Take a hard look at your 5471 data pipelines with this new lens, check your drop-down menus twice, and we will catch you next time.